Hello, Guido here from blockbuilders.net, and today I want to show you how future trading or derivatives trading on Bybit works. If you don't have a Bybit account yet, I put a link down in the description that you can use to sign up, and they always have like special promotions when you use that links that you can use and earn some free money. So once you have an account, you have to know that you need to verify your identity, and if you haven't done that during the sign-up process, you need to do it then. So you just go into your account and then identity verification and then verify now, and then you need to upload an ID or a passport, and then they usually automatically verify you. However, sometimes it can take a couple of hours if they have to check manually. So once you have done that, the next thing we need to do in order to trade on Bybit is we need to deposit some money there. And the easiest way to do it is we just click here on deposit, and then we can easily deposit cryptocurrencies. So you just select the cryptocurrency like Bitcoin, and then it basically shows you a BTC address where you can send the money to. And deposits in cryptocurrencies are free. And if you don't have cryptocurrencies yet, you can also deposit regular currencies like Euro, for example. I'm in Germany right now, so I would deposit euros, and there you just select the amount. It can be anything between 10 and 20,000 euros, so 1,000 euros, for example. And then the easiest way to do it would be a bank transfer via SEPA, and there you just select that, and then you click continue, and then they show you an account number where you can wire the money to. Here you have to make sure that your account matches so your bank account needs to match the Bybit account name. So you can't wire money from your wife's bank account to your Bybit account, and because the names are different, so you really need to make sure those accounts run under the same name. Otherwise they would send the money back, and that's just a safety measure for them. Okay, once you have done that, the next thing we need or we can do is basically we need to exchange that money that we just deposited into USDT, because most contracts here are traded against USDT, and there are several ways to do that. You can either convert that. So here you select your funding account, and you can select Euro, for example, and then convert that into USDT. It's pretty straightforward. USDT, or you can obviously trade that. Some currencies are traded against Euro, for example, USDT against Euro, so you can just select a market order and then buy USDT and select how much you want to invest here and then buy USDT, and that's basically it. Here you have to know that Bybit has several wallets in the background, so that's basically just a safety measure, and you can transfer money between these accounts easily. So here on that account you can, for example, transfer money from funding to trading account, and it's instant, so you don't need to wait on it, and it's obviously free, so you don't pay for any of the transfers here. And the advantage with that is that you can only use the money in your trading account. Okay, let's have a look at the trading contracts. So first of all, there are several contracts you can trade. There are USDT perpetuals, USDC contracts, inverse contracts, and USDC options. Inverse basically means that you can use cryptocurrencies to back up your position. However, the most popular ones are actually USDT perpetuals. If you just look at the volume here, Bitcoin was traded 3.76, or the volume for Bitcoin in the last 24 hours was 3.76 billion USDT. And for USDC contracts, it was just 10 million USDC, so not much at all. So really most people are trading USDT contracts, and you basically also have the most contracts here by far. So they have several hundred different cryptocurrencies that you can trade here. Here you have to know that's the difference between derivatives trading and futures trading compared to spot trading is that with spot trading you are actually buying a cryptocurrency that you can, for example, withdraw from the exchange and put into a hardware wallet or somewhere else. With futures trading, you are basically trading a contract, so you can't withdraw the cryptocurrency. The only thing you can do is basically close your position or open a position. And perpetual here means basically you can leave your position open as long as you want, so it doesn't expire at one point. However, you have to pay funding. We will get to that in a minute. Okay, when you open the derivatives portal or the contracts here, and you can basically see a price chart. One candle here right now is 1 hour. You can change that to like 4 hours or 1 minute or whatever you like. And then you have the order book, in red all the sell orders, and green all the buy orders. And then you have the interface here where you can actually open contracts or close contracts and go long, go short, whatever you want to do. You can select leverage here. So you can, for some contracts, for example Bitcoin, you can select a leverage of 100x max. So that basically means if you have 1000 USDT in your account, you can actually open a position worth 100,000 USDT. However, I wouldn't recommend that. I would recommend using 3x as a maximum leverage. With some cryptocurrencies that are not as volatile, like Bitcoin, for example, you can use 5x. However, I wouldn't go above that. And then you can basically select the leverage, and then you can select cross or isolated margin here. I would always recommend, especially at the beginning, to use isolated margin. That basically means you can only use the money that you have in, or that you use to open that specific position. With cross, it basically means they use all the money that is in your trading account. So if you have several positions, they basically take all the same, they take the money from the same pool, and it can happen if you have a high leverage that one position basically liquidates your whole account. So you really have to be careful if you use cross. If you want to open a position here, you can do it via market order or limit order. Market order basically means you select how much you want to invest, like 100% of your money or 50%, 25%, or whatever you like, and then you can either click on buy long or sell short. Buy long basically means you think the price will go up, and sell short basically means the price will go down, and then you just select your position. And with a limit order, it's a bit different. There you have to select at what price you want to open the position. So you can say, for example, okay, you want to go long if the Bitcoin price drops to 36,000 USDT. And then you say you want to invest all your money or 50%, and then click long, and then they would basically write the order into the order book, and there you can cancel it anytime. However, it would stay there until the price drops to that level. That's basically it in terms of market and limit orders. And once you have a position open, it basically looks like that. It shows you the contract here. So just for the sake of the argument, I just opened a Solana, TIA, and CAS contract here. And you can see the entry price and the current market price, and you can see realized P&L, so realized profit and loss. That's basically the cost I had for opening up the position, and then the funding. So right now for Bitcoin, the funding is positive, so it's 0.01%, and funding is collected every 8 hours. And you have a countdown here that goes to zero, and once it reaches zero, you basically have to pay the funding if you are in a position. If you close your contract a bit earlier, and then you don't have to pay it. However, usually the funding rate is very low, so it doesn't really make sense to close a position and open it up afterwards again, because the funding rate is usually smaller than the price you have to pay for opening up a position and closing it. And so the funding can be positive or negative. Right now it's positive. That means more people are long than short. And right now longs have to pay shorts. So if you are long, you basically have to pay that once the countdown runs to zero. If you are short, you would basically get that. And the funding rate can vary. So it can go up a lot or go down, be negative, whatever. If it is negative, you would actually receive money if the price goes, or if you are in a long position. So that's that. And then, as I said, you also have to pay the fee for opening a position, and it's either 0.02% or 0.05%. So there's a maker fee, that's 0.02%. That's basically when you use a limit order and you pay less to open an order because you are basically providing liquidity to the exchange. And if you use a market order, you are basically paying 0.05%, so a bit higher, because you are taking liquidity away from the exchange. That's why it goes up a bit. And yeah, and unrealized P&L is basically the profit and loss I would make if I would close a position here immediately. I can either do that via market or a limit order. By a limit order, I can again say, okay, if the price goes to that level, I want to close 100%, 50%, and whatever, and then I can just confirm. And that's basically it in terms of things you have to know about futures trading. If you have any questions about that, please feel free to use the comments down below. If you find that video helpful, please hit the like button and subscribe to my channel. And as I said, if you don't have an account yet, please feel free to use the link in the description. Thanks for watching.